Is now starting. All attendees are in listen-only mode.
Okay, we're going to go ahead and get started. Appreciate everybody for taking some time out of their Friday to get on this call. This call is to review the basically new report that we're putting out, going to be deploying on the mark-to-markets hopefully May 1st. Deriving the derivative asset or derivative asset analyzer. Basically, kind of born out of some of the issues, month-over-month issues that happened from the hedge accounting entries of the year before. Basically, just kind of jumping right into it. When we're looking at the derivative asset analyzer, or our current monthly accounting, hedge accounting entries, our current reporting measures the profitability, kind of month-over-month derivative asset profitability change that occurs basically on, born out of the mark-to-market and fair value loans held for sale and closed trades not settled entries. Basically, the new report, this derivative asset analyzer, really goes into why the journal entries changed. And, unfortunately, Rule ASC 820, which is a FASB rule, Accounting Standards Codification 820, basically requires us to report on our mark-to-market reports a list of journal entries, which most people on this call are familiar with, but unfortunately they're limited in scope, and they don't actually show the true profitability picture month over month. And so we'll talk about kind of those basically the causes of value change and what we're attempting to do on this report. But basically there's 5 categories that the five causes of derivative asset value change can be separated into. There's volume, timing, operational leakage, pull-through variability, and derivative asset performance. We won't get into too much on operational leakage. Most people, most everyone on this call is pretty familiar with the issues surrounding leakage, be it extensions not being charged for, or loans being committed to the investor and not actually achieving the purchase price that we were expecting on the commitment, for a variety of reasons. But so we won't get into too much regarding leakage, but we'll focus on volume, timing, pull-through variability, and derivative asset performance. As it says here, the volume and timing are experienced by even the largest, most profitable lenders in the country. They're perfectly normal. Those issues, are perfectly normal, and they can cause fairly large differentials month over month in your derivative asset entries. And the key is to make sure that we are pulling out the noise of volume and timing differences when we're looking at 1 month's derivative asset entries versus the next, to see exactly when we're looking to see if we truly do have a performance issue. And so, as it says here, it's essential to really strip out volume and timing to see if there's a derivative asset performance, or if potentially we have a leakage or a pull-through issue. Just to review hedge accounting, the requirement comes from ASC 820. Basically, recognizes that when an interest rate commitment is extended to a lender, or from a lender to a borrower, which contains positive margin. This creates a derivative asset which has an element of value to it, and of course that value has to be booked in these journal entries. The issue from a secondary standpoint, of course, is that there's some assumptions that go into that value. Because that value is not recognized, number one, we're marking that we're marking that value to market based on execution that's really just indicative execution, whether it's going to be agency or selling to the investors. That execution is not exactly, truly isn't guaranteed until the point at which we execute the loan and commit the loan. So we're making some assumptions on execution, and then of course we are we're forecasting for pull-through. So with respect to pull-through being, if we're assuming a 75% pull-through, 75% of the value pulling through, but in fact 70% of the value of the open pipeline pulls through, that's going to affect our monthly entries month over month. So and of course, in addition to the derivative asset value, that's going to be the open trade positions. Those are the TBA positions that have been shorted with the broker dealer and not paired off and then of course we have the open loans. The fair value of loans held for sale, which is going to be funded production and committed production, that's also booked. And then the closed, unsettled hedge positions are booked as well. So looking at just a journal entry breakdown here, this is from an actual client from 2/28. Just looking at the month-end mark-to-market journal entries for end of February versus end of March. And if we look at just on the one on the left here, which is going to be the month end for February, we see that we've got a derivative asset open pipeline of 2.6 million. So let's talk about what goes into that value. Unlike most of your summary sheets on your mark-to-market reports, you're used to seeing a pickup over and above a best efforts execution. This is going to be your pull-through adjusted gain on sale on the pipeline. In the past, the gain on sale was referred to as corporate margin. And so using an example of, an executable price of 104, let's say the best effort price was 103, and let's say that you had a 1-point corporate margin baked into that loan at the point of lock with the borrower, your originator price would have been 102. So we would have had a 104, and then we would have been backing out 102 to get us to arrive at this derivative asset value. Now, as we'll talk about further in the presentation, those recommendations have changed, where our accounting partners have told us that really the recommendation should be to go off of a total gain on sale approach. And of course what that means is that instead of backing out 102 from our 104 example of the execution of 104, backing out 102, having 2 points gain corporate margin or gain on sale, we would just be backing out par, just the par value of the loan. So 104 means that we're truly making 104. We're making 4 points. So you can see that this new, for the clients that are already on that, or for those of you who are moving that direction to account for gain on sale, obviously you're going to be netting the commissions and commissions payable. All of that's going to be netted out somewhere else. But the thing to understand with respect to our reports is that the magnitude of our reports of our net equity impact, these income statement impact to earnings, that fifth number down there, the magnitude is going to be a lot bigger with respect to a client who is who is marking these derivative asset values off of a gain on sale approach, because you're just backing par off instead of some originator price. So it accentuates potential problems when we're looking at net equity impacts when we take into account the reversal. So this, by the way, this client has about an $80 million open pipeline. So if we just take a look at the kind of the open pipeline value, what we're looking at here, we've got $2.6 million in the derivative asset pull-through adjusted open pipeline. We've got a derivative loss, so the hedge positions are out of the money, $240,000. That's going to get us to about $2.4 million gain on sale on the open pipeline. So you can see that $2.4 million on $80 million in an open pipeline, they're making about 300 basis points gain on sale. So obviously, key to understand there, they're not, it goes without saying, they're obviously not picking up 300 basis points to best efforts. That's their total gain on sale figure, 300 basis points, $2.4 million on an $80 million pipeline. The fair value of closed loans not purchased, again, this is just review. Most of you probably on the call are familiar with this. This is basically just funded loans that are funded on your warehouse line that are not purchased by the investor or the agency. So the cash experience hasn't occurred. So again, if it's the way it comes out of this number is if you're selling to Wells, it's purchased by Wells. If you're selling to Fannie, it's purchased by Fannie, and if you're securitizing Ginnie Mae, it would be literally your line would be funded off through the broker dealer. This number is going to differ a little bit from the number that you see on your historical P&L report with respect to looking at the loans that have been committed but have not been purchased. This is looking at all funded loans not purchased, whether or not they've been committed or not. So there's a potential that some of these loans could be still in the hedge. With the exception of our depository clients, the vast majority of the production in this figure, this fair value of closed loans not purchased, the vast majority of that production will already be committed at the end of the month. And then, of course, we have the accounts payable due to broker. This is a set-in-stone number. These are trades that have been paired out, so the price is set in stone, but the actual settlement hasn't occurred yet. So basically the cash experience has not hit from the broker dealer. Again, the price can't move, set in stone, but the cash experience hasn't happened yet. So the sum, the fifth value here, the equity income statement impact to earnings, this is the sum of those four numbers. And of course, as this says here, we have $5.9 million at end of February, and the end of March we have $5,027,000. Real innocuous when you look at them without the reversals. But of course, when we add the reversals in, we see the obvious problem. We have a nice positive net equity impact in end of February of $1.1 million. And at the end of March, we have a net negative equity impact of $955,000. Now, everybody on the call probably realizes which one of those, which month end out of those two is going to be more concerning to the customer, to you on the phone, and which will probably elicit a call from you to myself or some of our traders. And so just looking at that $955,000, really, this is our current reporting. And from here, what we need to do, there's no question, it's indisputable that this $955,000 loss or drop month over month in the hedge accounting entries, it's indisputable that has occurred. There has been a $955,000 drop in value month over month on these entries. However, these entries do not show secondary performance. That's the key that we need to make sure we're analyzing here. And so, as we said before, what we need to do is we need to strip out the normal basically the normal effects of volume and timing that have absolutely nothing to do with secondary performance. And we need to get down to a number that is actually, of actual positive or negative performance with respect to leakage, secondary performance, or pull-through performance. So if we look at going to the next slide here, just getting a little bit deeper into the causes, derivative asset volatility. Timing, is really the extent to which pent-up gains or losses are held in the derivative asset. All that means is did a huge cash experience occur the month prior. So let's look at this. You can see that those first four numbers, which of course make up the derivative asset, they do not include cash in the door. Now, obviously, I have no doubt that you guys are everyone on the call is correctly accounting for that somewhere. But the point is that when we're looking at this $955,000 differential, we're not including cash. So if we just use an example of this fair value of closed loans not purchased of $3.6 million, let's say 100% of that just got completely purchased out of the pipeline. Holding everything constant, what's going to happen is this fair value of closed loans not purchased in the next month is going to go from $3.6 million, and let's say no new loans came into it, it's going to drop to zero. And then of course when we reverse back out the prior month, we're going to have this huge loss. And that's actually not what happened in this case. We'll show these exact numbers in the new report to analyze what actually happened. But as far as timing, the timing effect is really the extent to which basically gains or losses are pent up in these figures, and how much cash has cycled through or needs to cycle through. Volume is real simple, especially when you're measuring on a gain on sale calculation. It's going to have a direct effect to the total value, and that's pretty simple. If we look at the example that we have here on the left, we had 2.4 million net. We had 2.6 million in the derivative asset, 240,000 in the hedge instruments for a net gain on sale in the pipeline of 2.4 million. An $80 million open pipeline equating to 2.4 million in value. If we hold everything else constant and we drop from 80 to a value, let's say, of 40, so we cut the open pipeline in half. If we hold the profitability constant, you can see that our open pipeline profitability or total value would go from 2.4 million to 1.2 million. That's fine in itself when you're looking at it this way, when you're not reversing the two. But of course, if we were just looking at holding everything else constant, if we have a $2.4 million open pipeline valuation the month before, now volumes are half that, and we have a 1.2 the next month, you can see the obvious problem. We've now got a $1.2 million loss in the derivative asset. Obviously, no issues whatsoever with respect to profitability. You can see yes, the derivative asset entries have changed, but by the time you've netted those out with with actual cash in the door and your other entries, there should not be any effect. These volume and timing should not have any effect on actual secondary profitability. Again, we won't talk too much about leakage. Leakage is the extent to which margin compression is experienced between lock and purchase. So during the lock, obviously lock extensions that aren't being charged for, any margin compression, changes in the loan that just can't be charged for. And then of course at the point of commitment, we're looking from lock all the way to purchase. because what's going to affect, the analysis or performance just in general is if we're expecting in our fair value of loans held for sale, a higher number than we're actually achieving when cash comes in the door. That's gonna alter the analysis, and frankly, that's a legitimate, secondary profitability issue if there's a substantial amount of leakage. And again, the reason that I'm not, won't focus a lot of time on leakage is that we have some pretty good analytics on leakage in our current reporting. Everybody on this call has a data change summary, which is going to basically show the difference between. It's going to look at, for any material change. It's going to look at the loan as of yesterday, look at it as of today, take any loan that has a material change in it, with respect to LLPAs or base price or SRP. It's going to take yesterday's data, it's going to run it through today's pricing model, then take today's data, run it through today's pricing model for the same loan, and compare the two prices. And of course, if there's a degradation in price, it's going to highlight in red. So we would have that, and of course that's going to be in the reports. But that, obviously, leakage is something that definitely needs to be taken into account. It needs to be measured and obviously controlled to the extent that it can be. But for purposes of this analysis, we'll leave that to the rest of the report and your pipeline management. So pull-through variability is the extent to which the pull-through adjustment made to the derivative asset value in the prior month has not materialized into actual experience. So what does that mean? So basically, we are haircutting the open pipeline profitability by a pull-through measurement. So we're forecasting, if we're forecasting, let's say, 75%, if let's say we've got a gross pipeline value of $4 million, and we're forecasting we're forecasting 75% of the value to pull through, we're expecting to get $3 million in value out of that open pipeline. Now, one thing, notice I said 75% of the value. The value of the pull-through analysis may be different, or the value of the pull-through haircut may be different than the volume haircut, meaning that I can't just take, if I'm expecting, let's say I have a pull-through on my coverage breakdown tab, a forecasted pull-through of the open pipeline of 73%, I can't multiply that 73% times the open pipeline volume and arrive at my actual derivative asset entry. Those numbers won't reconcile, and the reason is that our model is biasing pull-throughs for lower profitability loans higher than it's biasing pull-throughs for loans that are in the money. So if a loan is substantially in the money, it depends upon your historical pull-through, but to a certain extent, our model is definitely going to pull down the expected pull-through of that loan. So again, we're looking at value. So you can see that there could be a potential, like if we expect, let's say we expect $3 million of that $4 million in value to close, so 75% of the value, but in fact, only, let's say, only 2.5 million closes. 2.5 million in value closes. You can see that we've overestimated the value of the derivative asset in this case. And so, and to be clear, going back to my example about pull-through values, pull-through adjusted values differing from pull-through adjusted volumes, you could definitely have a situation where your pull-through, let's say we were expecting 73% pull-through, you could actually come very close to 73% pull-through, but our pull-through adjusted value that we actually achieved on the open pipeline was substantially off. And the way, of course, that would happen is if let's say all of your unprofitable loans held on, and for just the by luck, the top 27% of your loans, so all of your fallout, was the most profitable production. You can see that our model can't expect that. So we're gonna have basically a drop from what we actually expected. And we'll show you how we measure that in a second. And then, of course, finally, there's derivative asset performance. So this is the measurement of whether or not the prior month-end mark-to-market, actually, reflected the actual secondary execution that you received at the point of commitment. So, and then, of course, the question below, are changes in the asset price movement, are they warranted by the corresponding TBA price movement? The bottom line is that, this was a serious question in the months of May and June of last year. We obviously, looking at these 5 issues, the number one issue if we talk about June month-over-month profitability, where a lot of people saw a big derivative asset move, the number one issue was volume. Everybody was rocking and rolling at the end of April, beginning of May, had huge open pipeline volumes. And really, by the end of June, by the time all was said and done, volumes had already substantially shrunk. They were still probably higher than they were in the first quarter of this year, but when compared to volume levels of April 2013, which were record highs for a lot of people, volumes had been decimated. So that was the first and foremost problem when we were looking at the derivative asset month over month. That said, unlike the 10 years prior, there was an issue with derivative asset performance as well, where you had, this question as to, was the price movement in the asset warranted by a corresponding TBA price movement? And the fact is that in June, especially with some of the top investors out there, it frankly was not. You saw drops because no one out there kind of wanted to catch a falling knife. You saw situations where the investors were pulling back in price faster than the actual corresponding TBA was dropping faster than we would expect it to drop. So that was that would have been a legitimate derivative asset performance issue causing a secondary causing a deterioration in secondary profitability. Again, the first issue, going back to June, and the biggest issue, frankly, was the volume drop. And obviously that's frankly going to happen. It doesn't have anything to do with secondary profitability. So again, this is the top part of the derivative asset analyzer. We'll go through kind of what this additional sheet's going to do, what it aims to do. But again, the biggest issue, the main goal of this report is really to strip out and determine to what extent the volume and timing causes have had. So again, indisputable that, by the way, these are just the numbers coming directly off. I'm going to go up a couple slides here, directly off of these journal entries. Okay, and we're looking at March 31st. The fact is we've got $1 million loss on our derivative asset, and you as a client obviously are concerned about that, rightfully so. So this first part basically just copies the only additional thing that it does here is it just shows the corresponding values. So right off the bat, you can see derivative asset open pipelines are pretty similar. We've gone from 59.6 million to 62. But there's been a big change. You can see right off the bat a fair value closed loans not purchased going from 84 to 62. So we've had a $22 million delta month over month in that. But again, we're getting right to that 955, 349 loss month over month. So the first order of business is we want to stabilize for what we would call stabilize for cash, for the cash experience. And what this does is this is going to it's going to take a look at the timing effect. Because again, flipping back down here, what happens, when, we're looking at two stages, when we're looking at these journal entries, we're looking at two stages of a three-stage process. We're looking at the derivative asset open pipeline. We're looking at the fair value of closed loans not purchased. But we're not looking at cash in the door. And when we're truly doing a secondary analysis to see exactly what happened, we need to look at cash in the door. So cash in the door, of course, that's production purchased off of your line. Again, by the agency, by the securitization, by the investor, whatever gets purchased off your line is going to fall into this. So in this example, 55.2 million got purchased the prior month. 40 million got purchased the current month. And so you can see that volume differential, there's a $15 million drop. So when we look at what we made cash-wise, the prior month we made 2.1. The current month we made 1.5. So you can see actually the cash actually makes the situation worse because we're backing out 2.1 from a 1.5 number this month, giving us a negative 600,000. Then we have to look at the settlements. So the settled hedge instruments is 32 million the prior month, 41 million this month. So you can see we lost 557,000 the prior month on settled hedge instruments. This month we lost 421,000. When we net those two out, we gain 135,000 back. But you can see when you're still adding basically an additional $450,000 to the problem. When we stabilized, or when we've taken a look at timing, you can see that the actual performance here has actually gotten worse. We're now looking at, on 199 million, we're looking at a $1.4 million loss. How do I get the 199 million? Well, what I'm doing is I'm taking the 59.6 in the open derivative asset number. I'm taking the 84.2 in the fair value closed loans not purchased, and then I'm taking the 55.2 in the purchased production. Now that's the entire population that we're looking at. Now luckily there's one more stabilization factor that we need to look at, and of course that's volume. So how much volume is in this total analysis? And you can see there is a substantial difference. Last month we were looking at 199 million. This month we're looking at 164. So we have a $34 million drop. We're going from, and of course we're getting the 64 by adding the same numbers, the 164. We're adding the 62 in the derivative asset, plus the 62 in the fair value of closed loans not purchased, plus the 40 in the purchase production. So what we do is this is the last part of the sheet here, and you can see that we need to stabilize based on volume. So what does this say? Okay, so we've got a $34.2 million drop in the population of loans that we're doing the secondary analysis on month over month. Okay, so now what we need to figure out is what on average were the loans making. So on average, you can see to the right of that, so negative 34 million, we've got a 376 basis point gain on sale. On average, this 199 million was making 376 basis points. So if you think of it this way, if we're dropping 34.2 million out of an analysis that was making 376 basis points, you're going to expect, based on the volume reduction, you would expect a $1.2 million drop in gain on sale. So you'd expect a 1,289,524 drop in the gain on sale. So now when we net the 1.2 million out with the 1.4, you can see that we have a much more manageable number of $136,000 month-over-month change. And so that is the whole essence of the analysis. The it's going to take some time, for this to sink in, as far as getting comfortable with these numbers. But as far as looking at the two kind of call them innocuous causes of month-over-month journal entry variation or differentiation, volatility, call it. The two innocuous causes are going to be timing and volume changes. So you can see the timing was not the issue here. Timing actually, when we adjusted for timing, the issue got worse. But the reason when we adjusted for timing that the issue got worse is you can see that when we adjusted for timing, we had 55.2 that were purchased the prior month, and only 40 million purchased during the current month. So you can see that we were just looking at a much bigger population of loans, and we had to adjust for the volume. Now, as I had said earlier, we'll be deploying this report on May 1st. You'll be able to match this up. You'll be looking at this with your journal entries from the reversals of course March versus April, but it may take some time to settle in, but hopefully this would be something you were comfortable with by the time end of Q2 rolls around. Now, if we're going to get into actually analyzing the actual derivative asset drop. Basically, this is really stabilized for the innocuous factors. Now we do have a true $136,000 differential. But one thing to understand is this is a $136,000 differential on $199 million in volume. So we're talking about a 6.7 basis point differential. So it's not a huge, definitely not a huge move by any stretch of the imagination. And but if we wanted to analyze exactly what happened, there's an additional basically performance analysis breakdown that we have. And if you're really trying to analyze, okay, what happened in my derivative asset? Now, there's two components, obviously, to our journal entries. There's our derivative asset component. That's going to be open loans, open trades. And again, when I say open loans, I mean loans that are locked with the borrower and not funded. And then there's going to be the other component is going to be the fair value loans held for sale, and the fair value kind of due from payable to broker-dealer on the closed trades. We're just going to be looking, when we're looking at a derivative asset performance, we're just going to be looking at the derivative asset piece. Obviously, the trade positions, they're going to perform by definition, they're going to perform with the market. Because they would be, your independent variable. They're not of concern. The concern is, of course, how did your derivative asset on your loan production perform? So when we look at, how did we get from, again, just purely on the derivative asset side, when we look at how did we get from the current month to the prior month, or I should say, how did we get from the prior month to the current month? You can see that there's basically four buckets here. There's new locks. Those are loans that have been locked into the pipeline. Basically, they've been locked into the hedge during the month. So after the prior month mark to market, and still exist at the end of the month. And that's really important. Let's say you had a really extremely short lock term, and remember we're looking at in this analysis, we're looking at end of February versus end of March. Let's say on March 7th you had a 7-day lock already approved, and it went to Fannie, so it was purchased really fast. That lock would actually never enter this calculation. It would never enter any of our journal entries because it's come into the pipeline, the derivative asset has appeared, then the derivative asset was funded, it moved to a fair value loans held for sale, and then it was purchased, so it moved to cash right out the door, and it's never going to enter either of these numbers. So the key is that this new locks figure, these are new locks that have been locked during the month and are not funded at the end of the month. Okay, so in this case we've got $47.5 million. Fallout is obvious. These are loans that were in last month's marked market and have fallen out during the month. And then of course fundings represent fallout as well with respect to the derivative asset, because when we're looking at loans that fund, as soon as they fund, they fall out of the derivative asset and they move to the fair value loans held for sale. So the additions are going to be $47.5 million, and then the removals are going to be $7.25 and $37.2 million. And then, of course, we have the final figure, which I refer to as enduring locks, which is going to be, those are locks that were in last month and in this month. And so for these 4 buckets, the goal here is we're really just analyzing what happened, what exactly happened to the value. So let's look at the new locks here. We've got $47.5 million in new locks. We had an initial value of $1,870,000. So what does that initial value represent? What that is that is the mark-to-market value of the loan the day it came into the pipeline. Okay, and again, it's the gain on sale value of the loan the day it came into the pipeline. The final value, of course, because remember these are all locks that are still in the hedge, is the mark-to-market value as of the month-end mark-to-market, so 3/31. Now you can see we started at 1,870 and now we're at 1,671, so we've lost about $199,000 in value on those locks. Now remember, we haven't lost $199,000, we've just dropped from our initial mark-to-market value $199,000. When we look at the market difference, though, we've had a 34 basis point drop in the market. So our market-driven delta, we would have expected to lose on our mark-to-market $145,000 of that current for that population of loans. We actually lost 199, so our net performance in this case is going to be negative 54,000. So we did have a hit. You can see negative 54,000 on 47 million. We're looking at about 11 basis points. That's kind of the facts of life, is that their margins, there is some investor margin management out there. Derivative asset values can go up and down, but the key to understand here is that and what this report is meant to show is that, just flipping back all the way up to our original monthly entries, we started with a $955,000, literally $1 million hit, to a respectable pipeline, but not an enormous pipeline. I mean, $1 million hit is a big number. But by the time you adjust for volume and timing, and then you begin to look at what happened to the performance, you can see that really there wasn't a whole lot. There wasn't a whole lot of derivative asset degradation. As far as where you would go from here to explain the other 136, that's when you would, you're talking about 199 million in loans, so you're going to have to look at, actual leakage. I'm not saying that 100,000 leakage occurred, but you would want to look at leakage, and then from there we would look at some pull-through variability. but definitely possible that 40 or 50,000 in leakage occurred on a $200 million population. So that's really the analysis and the report in general. Just some some potential pitfalls that really you're probably already experiencing, if any of these pertain to you. But it's something to think about that this derivative asset analyzer will still be skewed by. First, when you're selling servicing retained, the MSR value when we're marking the loan to market, we are marking that loan to market with the agency price. Let's just take a Fannie, and then we're sticking the 100 basis points or whatever. Either we're getting it from Phoenix, or if you have a if you have your own grids that you've provided us, or if you're selling on a flow servicing transfer agreement that you've given us, we will provide those. We'll provide those in the mark-to-market. Now, once that loan gets committed, the issue, of course, is that in some of our, it depends on the client's LOS. If we're able to continue to book the MSR asset on the fair value loans held for sale, that's fine. Now, the key, though, there is that we need to make sure that you're not double booking that somewhere else. And then, of course, once that loan is purchased, this is extremely important. Once that loan's purchased, by definition, you are going to be accounting for that MSR somewhere else. So it's not going to show up in our analysis, meaning that you're only going to see the cash value. So you would, all things being equal, let's say there was a 100 basis point MSR value. When you, looking at our analysis here, when you saw this production flow from fair value of closed loans not purchased into the purchase production figure, you would actually see a drop for those loans. You'd see a drop in execution of a point because we've got the 100 basis points baked in. So that's number one to take into account when you're looking at this analysis. Change in the hedge accounting benchmark. We talked about earlier in the past. It was pretty customary to use corporate margin. So we're talking about the mandatory execution. Let's use the example of a mandatory execution of 104, backing out 102 of the original price gives us a 2-point execution. Now, if let's say you decide to change during 1 month, you change from a lender corporate margin basis to a total gain on sale basis, you can see the obvious artificial increase that you're going to have. Using that exact loan, 104 in a mark-to-market execution, you go from a 200 basis point gain on sale to a 400 basis point gain on sale. So the derivative asset will experience an artificial increase in the month that the change is made. So that's a key to understand there. And then this is specific to basically to benchmarking your gain on sale to total gain on sale, I should say. The change in the weighted average originated note rate. So if you begin to, for whatever reason, change your originated note rate relative to the market rate, that's going to artificially change these numbers because again, we're benchmarking off of par, using the gain on sale method here. Now, I have no worries. I'm completely confident in, that everyone on this call is, accounting for that somewhere else. I mean, I'm perfectly confident you guys are, accounting for your additional commissions or reduced commissions or additional borrower rebates or points somewhere else. But the point is that with respect to our numbers, what we're reporting to you, they're going to change based on, this originated note rate. So the classic example, is if you were to go from some, although this probably isn't the case right now, if you were to go from some purchase-oriented, you know, origination where you you had a lot of borrowers that didn't want to bring money to closing, so you obviously had to rebate. So you're going to be originating a higher note rate. And then if you opened, let's say you opened a consumer direct or just a market-savvy, sophisticated borrower, like a bank rate origination, you're going to obviously have a lower mark-to-market execution, probably going to have a lower buy price as well. So the margin might not change at all, but the point is that you're going to have an artificial drop in your mark-to-market, in your derivative asset mark-to-market valuation. So again, I think the key point to understand in this whole, report is that, and the whole presentation really is that, we perfectly understand that these numbers are all these additional entries are probably getting cash in the door, be it volume changes is probably recognized elsewhere in the report, but unfortunately because ASC 820 requires us to report the journal entries in the way that we do, when they're looked at in isolation, they can really make some artificial headaches because which I think is unfortunate. So this derivative asset analyzer, we're hoping and we're pretty confident will basically remove a lot of those headaches when you're able to see that the extent to which the value the value change month over month has been because of volume or timing. And the bottom line is that in our over the years in our analysis, over 90% of the issues, over 90% of the issues are the vast majority of the value changes because of volume and timing, which again is completely innocuous. So so that's really it. We will be sending out this presentation to everybody on the call. And like I said, the report will this report will be in your beginning of May marked markets. And if you have any questions in the meantime, or especially once you get the report, definitely call me or your trader to discuss. And please let me know if you have any questions. And appreciate everybody's time. All right, thanks a lot.